Well, hello and welcome to my video assignment. My name is Thomas Vos and I'm doing this for digital trading and financial assets. Sometimes I look to the right because on the right is my other screen and there's presentation presented to me so that I can track on how far I am in the presentation. Um, there are a few subjects. The first two subjects are about something I have learned during this course. And of course the third one as well, but that was mandatory. So, and the first subject is compounding interest. The second subject is leverage trading, and the third subject is technical analysis. Compounding interest. I'm first gonna separate the two words. So compounding and interest. Compounding is something that differs from linear growth. I'll get there in 1 second. What that exactly means. Interest is the monetary charge for the privilege of borrowing money. So easily said, you borrow money to someone, and someone is going to reward you for borrowing that money, and that's interest. So, for example, we'll go in for an example in a bit, but those words together, compounding interest is you receive interest, and together with the initial amount plus the interest, you will reinvest again. So it's a bigger sum, and if you get a percentage of that, then it's going to be bigger and bigger and bigger and bigger. I want to go back to compounding. It derives from linear growth. Now, to you guys, to choose which one is linear growth. What do you think? 1, 2, 3. This one is an exponential growth, and that's most likely to be compounding interest. Probably, I think maybe it will not be as a beautiful line as this one, but it would certainly not be a linear one, except if you pull your money out. But then the whole concept of compounding interest doesn't go up. Practical example, you have $1,000 you borrow, you lend, you get 10% after 1 year, and the loan is also paid in 1 year. So after 1 year, you got your money back plus interest, and then you can calculate it how it will be in about 30 years, for example. So the calculation is the future amount is the initial input times the interest, and that to the square to the years. So this is your first 1,000, and after 30 years, you're almost making 8,000, but you only put in $1,000. I took 10% because it's an easy example, but on average, you can expect to get around over the 30 years a return of 7%. That's also what history has proven. Where and how to use bonds. You got a coupon you get every month or every quarter. The bonds usually take maybe 5 to 10 years to be fully paid back. So every month you get your interest, and after the period you will get your initial input. Stocks, there you need dividends. You need quite a bit of shares to pay for another share with your dividends, but it is possible. And rights, real estate interest fund, trust, investment trust, sorry, you will get a percentage of the rent, so you can reinvest in the same trust or another trust. My next subject is leverage trading. Again, I will split it to words. So leverage, in this case, using borrowed money to increase the ability to put in a bigger trade. So you're borrowing money, and trading is buying or selling security for potential profit. Putting those together, leverage trading is the ability to buy or sell more securities that someone could with their own money. So you only got $100, but you say to the broker, "Hey, I want to make this trade, but I think it's gonna be pretty good. the broker can say, okay, I will give you the rest so you can borrow with $40,000 instead of 100. So that's the leverage. But you see, you will take your initial one, and that's times the broker is willing to pay you to buy the security. The $100 is called margin, and it's all the brokers have margin is the percentage of someone own money in a trade. So there's always money in your own trade, and you got this in ratios, and that also got in percentage. So for example, 100 to 1 is you only invest 1% of your own money into a trade that is 100 times bigger. I got a little example. Unleveraged against leveraged. So unleveraged will go first. So for example, and both examples are almost the same. So one share is $100. You got your personal money, so the money you could invest is $1,000. So you can buy 10 shares. Well, if the share price goes up to $120, you have a profit of $200, and that equals to 200%, 20%. Sorry. Share price goes down $80. That means you lose $200 or you lose 20%. Okay, keep that in mind. Leverage with leverage, the same case. One share is $100. Personal money is $1,000, but the margin is 10%. So again, you only have to put 10% of the whole trade. You have to put in 10% of the trade, and that is your own money. So for again the same example, 10 shares are $100, so you're trading with $1,000, but the margin is 10%, so you put in only $100. In this case, if the price goes up 120, it's still $200 profit, but you put in only $100, so that's $200 profit, 200% profit. So that's the real good case. But the downside is, if it goes down to $80, you'll lose $200 still. But percentage-wise, it's twice the amount you put in. So you owe the broker or the one that lends you the money another €100 only because the price did go down. So there's a big upside to leverage trading, but there is also kind of a big downside. There we go now. I know. First, go and put options, my excuse. With leverage trading, you don't actually trade stocks, you trade contracts, securities. And option trading, options are an instrument that gives you the right to buy or sell, and not the obligation, an asset. Most of the time, the contract has a expiring date, so you have to really be careful when to buy it, or if you want to liquidate the contract. So you actually buy or sell the asset. The price of the option is most likely linked to the value of the asset. So the contracts probably will be in the range of the actual value of the asset. Call options give you the right to buy buy assets, and put options gives you the right to sell assets. And you got no shareholder privileges because you don't have the actual shares. Risk, you could lose more money than you have available, so the broker is forcibly to sell your assets, or holding a position open for too long because you think maybe the price will go down, so you buy another option, or you just keep opening, and holding your position, which we could return in a massive loss. By technical analysis, is about Shell. Shell is one of my best performing assets in my portfolio. So I wanted to check how does it work, how is it going technically, and it's an oil and energy company. The patterns I found were on a 1 day time frame. I could find some rising wedges, so that indicates there's a bearish period coming, maybe. They were backtesting the horizontal line here, the resistance, the money flow index, and the relative strength index are pretty high, so that indicates they're probably going to sell a bit. The volume is also not really great, so it's probably not going to cross the line because traders probably don't think it will. And in the history, a while back, the chart showed the same things I was thinking. My risk per trade and my price levels, risk and price levels. My risk per trade is 2%. So if I put $1,000, maximum loss will be $20 only. Trade direction, I will go short. So I will buy a put option and I will keep the trade open for 10 days. The stock is in euros, so I had to convert the dollar to the euro. And I could buy 32 shares with $1,000. My entry price is 48 and 5. My exit price is 27.09, so that equals to a 4.83% profit. My stop loss level is 29 and 5 cents, so that equals to the 2% risk, and a risk reward ratio of 4.8, which is, to Investopedia, a pretty good ratio. Thank you for listening, and see you next time.